really does come down to on an individual basis. However, we generally find that, overall, if you have a company that is the trustee for a trust, that is one of the best ways to protect your assets. So what we mean by that is, you might, myself for example, we might have, my wife owns all the assets, and however we've got all the liabilities that are structured around myself. So don't be over concerned like that. If my wife leaves me, she can take all the assets and I'm left with the debt. Good thing about the family law court is they divide everything up. They unravel trusts and companies, and they divide things, hopefully, I'd like to say, evenly. With a company structure, being the trustee, is you then have your assets that are held within the trust. So it all depends on what we're trying to achieve, and we've got to look at, what are you trying to do? Are you creating a business? Are you buying properties? Are you trading shares? Those are the things that we have to look at before we can determine what's actually best for you, because everybody's different. We've got to look at those sorts of scenarios. Yeah, look, a lot of people actually look at it like that, and that's not always the case. It's just that trust can actually be used in terms of protecting your assets, right? But also, I'll give you an example. Quite often, a lot of people think that that by having one or two properties and all that sort of stuff, if it's in your own name, quite often I hear my clients say, "Oh, that's all right. I've got public liability insurance." Now, here's an example. If I came around to your house and I happened to mention that your front stairs are a little bit faulty, and you said to me, "Yeah, look, I've been meaning to get around to fix those." Now, if I was leaving your house and I actually happened to break those stairs and fall down and break my leg, and me being the nice guy I am, I turn around and sue you, basically your insurance company will turn around and say the fact that you actually knew about those stairs and you should have fixed those, therefore you are negligent, and they will not pay out. I will then come after you to, and if you've got equity in your properties or whatever the case may be, I'll end up being your landlord. So those are the sort of things we've got to be very, very careful of. However, if your properties were actually inside a trust, okay, I wouldn't be able to actually sue you for those assets. I can sue you personally, and because you don't own anything personally, your trust does, there's no point suing you because we're not going to get any money out of it. Okay? Those are things we've got to be very, very careful of. So a statistic, and I'm sorry I can't remember where I heard it, but however, apparently apart from the United States, the next two countries, right, and I know they said countries, but the next two places that are actually had more litigation than anywhere else in the world, one is New South Wales and two is Queensland. So that is a scary, scary thought, and that is why your whole wealth protection strategies are so important. You must take the 7 steps seriously to create or protect your wealth. What you've got to look at though, when you're putting something in a trust, you've got to work out why. Now, if someone's on $150,000 a year and they turn around and they say, "Mark, I want to buy a property and I'm going to put it in a trust for for asset protection, but I want all the tax, or I want all the tax benefits as well." Well, it still can be done in some cases, but quite often now, the way they used to do it was what they call a hybrid trust. And what a hybrid trust basically can do is it can protect your asset. You can look at having the capital gains go one way, but also all the tax depreciation or the tax benefits go another way. The ATO really doesn't like those anymore, and they're getting harder and harder to actually form and run correctly. Definitely ask your accountant about whether to use a hybrid trust or not. But primarily, if you're looking to buy an investment for the tax benefits, then there's a good chance that the best thing to do is to actually have it in your own personal name. Having things in your own personal name isn't that bad, okay? It's not the be-all and end-all to have them in trust. You've just got to work out the overall strategy of what you're trying to achieve. There's some other little tidbits that you potentially can do to protect the equity inside those properties. Now, for those of you who are going, what's equity? Equity just is the difference between what the property is worth and what you owe on it, okay? So if you had a $500,000 property and you owed $400,000 on it, the equity inside is $100,000. That's what we look for. So you need to look at protecting that equity. That's the key. The 3 main types of trusts are a discretionary trust, a unit trust, and a hybrid trust. Now, a discretionary trust is the main one that people use, okay? And all it really does is it allows you to give it, a family trust, discretionary trust, whatever they want to call it, but it gives you the ability to distribute income however you wish, basically. So if you've got, if one of the beneficiaries on the discretionary trust earns 150 grand and someone here earns 10 and the other one earns 0, then you'd want the income derived from the trust, you would want to distribute to the ones that are earning less, so that therefore the tax minimisation plan's in place. That's one of the key things about a discretionary trust. A unit trust means that you can actually own units within the trust. So, in the case of Acquire, we looked at setting up a unit trust so that we could actually sell units inside, to own bits and pieces of Acquire. And it's a good way to actually, determine if you are doing a joint venture, a JV, and you've got $100,000 and your mate's only got 50, therefore you can actually distribute your units according to the amount of money you've actually put in. With a unit trust though, the actual income or the capital gains or whatever you're doing with inside that must be distributed according to those units. So if you own 60% of the unit trust, your mate own 40% of the unit trust, if you make $100,000 inside that trust, $60,000 goes to you, 40 grand, it must go that way no matter whatever else is done. A hybrid trust, however, is the benefits of both. So you can actually distribute the income according to however way you want it, or you can actually distribute it according to the units that you own, right? Definitely need to get good quality advice if you're going to look at using a hybrid trust. It's one of the least common ones out there, and it's one of the most complicated as well. So primarily I would say I'd say even as high as 80%, 90% uses a discretionary trust, and the other 10% would be sort of, a combination between the unit trust and the hybrid trust. So just quickly make sure that whatever you're doing, talk to a good qualified accountant. We have some great bonuses at the end of this session that you can actually look at either setting them up yourselves. We've got a CD that you can look to use. You can purchase that, or you can actually go get a free consultation from one of our preferred accountants.